So I am so pleased that Richard Monks, Director of Strategy at the FCA, is with us today to talk about this area. As I said earlier, I'm being asked so many questions on this, and it's wonderful to be able to hear direct from Richard. I need to say, first of all, though, that his team have been really good at communicating with us and asking for opinions so that we don't get knee-jerk reactions to how we deal with this area. So it's been an absolute pleasure working with Mark Manning and Freddie, who are also basically both listening today. So to say, Richard, your team are on and watching us today. And with that, I'm hoping that Richard is on the screen somewhere.
Yep.
Fantastic. And Richard, I must also say, you're one of the other people from all the speaker information that I sent out who doesn't look anything like their photo. There are so many people from the information that we sent out that no one would be able to match the right person to the right photo. But that is lockdown times for us. Anyway, on that far too glib note, welcome. Please go ahead. The floor is yours. You have half an hour, and I know you said you were going to break a little bit early, and we'll take questions.
Yes, I hope to do so. I hope to get through this so we get a good 5 to 10 minutes of questions at the end.
That would be good, and I will do my best to man those or person those. And I don't know how that's going to go at all, but we'll just see how we go. Anyway, over to you. Thank you,
Julia. Thank you, and thank you, and good morning to all of you, and thank you for attending this event, which I think is a crucial event as we try and take the sustainable finance agenda forward in financial services. As Julia has said, my name is Richard Monks. I'm the Director of Strategy at the FCA. I enjoy most aspects of my job, but the thing I probably enjoy the most is that we have responsibility for the FCA's work on sustainable finance. It's a really critical agenda, obviously, in the world. It's a critical agenda for the FCA, and I'm delighted to have the opportunity to speak here today. First, I'd just like to thank Julia for the invitation this morning, and Julia for your commitment to this incredibly important subject, not just in recent years, as it's become increasingly trendy and looking like the future, but in fact over the last 2 decades as well. I think today we are living in truly extraordinary times. COVID, I think, has resulted in the most significant change most of us have ever gone through. And when many of us are in retirement homes or talking to our grandchildren, we'll be telling stories about the pandemic in the same way that my grandparents certainly talked about the Second World War. And I think those grandchildren will probably say, whatever granddad or whatever grandma, they'll run outside to play on their hoverboards, and we'll sit round drinking tea and keep on talking about our COVID stories. So we are truly in unprecedented times in 2020. But I hope that by 2040 or 2050 or 2060, we'll be living in a net zero world. And I hope the hoverboards of our grandchildren will be environmentally friendly. And if we achieve this, I suspect we'll look back at the pandemic and look back on 2020 as something of a turning point. Governments around the world will need to play an active role in rebooting economies. And this reboot will provide a great opportunity. The UK government has placed a green recovery at the heart of its plan to build back better. Earlier this month, China committed to being carbon neutral by 2060. There is clearly a very long way to go, particularly in turning these aspirational targets into reality. But the political will is stronger than ever before. The demand from investors is also stronger than ever before. Sustainable investment products are currently the fastest growing segment of the market. A recent Scottish Widows survey, Investing Responsibly for the Future, found that 81% of those surveys thought we all had a responsibility to make the world a better place. Almost half would accept slightly lower returns to make ethical choices, and more than 60% said that sustainability was an important issue to them. But the demand is clearly there. It's often no longer seen as a compromise between ethics and financial return. And investors are putting their money where their mouths are. These aren't just words. Recent fund flows tell the same story. According to Morningstar, ESG products accounted for almost 1/3 of European fund sales in the second quarter this year. So today I will outline the FCA's work on sustainable finance. We want to help firms deliver sustainable investment products that consumers and investors want to buy. We also want to help those consumers and investors make better informed choices. And as this audience knows well, this is easier said than done. There are a wide variety of sustainable investment products available to consumers, and these employ a very wide range of strategies. Some of these strategies screen out investments with poor ESG performance, such as highly polluting companies or companies that don't treat their workers or suppliers fairly, for example. Alternatively, there are strategies that directly target tangible real-world impact, perhaps accepting the possibility of lower financial returns to do so. And these are just two examples. The development of new products to meet evolving needs and preferences is a really good example of innovation in the interests of consumers. And this is something we firmly encourage. We have a duty and an objective to promote competition, and we see investor choice as a very positive thing. But it's also crucial that consumers understand these products and the differences between them. And as regulators, we need to make sure that consumers can trust these products and ensure consumers are given the right information so they can make informed decisions. So firms must ensure their communications are clear, fair, and not misleading. And we don't expect to see firms exaggerating green credentials. This is greenwashing, it's misleading, it's absolutely unpermissible by our rules. So today I'd like to talk about three main issues we've identified in our work, and then 5 actions we are taking in response. As part of this, I'd like to outline some of our really early thinking on proposals we are considering to create some guiding principles to help firms with ESG product design and disclosure. So the first theme, or the first main issue I'd like to discuss is data and information. So at present, corporates and companies' non-financial disclosures, they are often incomplete, they are difficult to compare. Now, there has been really good progress in the last couple of years. I think the most notable is the widespread voluntary adoption of the recommendations of the Task Force on Climate-Related Financial Disclosures, the TCFD recommendations chaired by Michael Bloomberg. But significant gaps remain, and investors aren't getting the full decision-useful information that they need. Across the FS industry, there is a reliance on ESG ratings, but these rating providers also rely on the public information provided by the corporates. So their outputs are also subject to data gaps. And they also have very different methodologies, which can lead to a very wide variation in ESG ratings for any given company. So, as an example, if we consider Tesla, the electric car company, this is rated as high risk by one rating agency, Sustainalytics, but receives an A grade from another, MSCI. Now, this divergence in methodologies isn't inherently undesirable. After all, well-functioning markets rely on trading between different actors with different views. And there are equal arguments as to whether Tesla is an environmentally friendly proposition. But there may be a concern if firms are using ratings mechanistically. For example, without a detailed understanding of the methodologies that providers apply and careful consideration of whether they are fit for purpose. So data and information, I think, is the crucial first theme. I think a second theme in terms of things we are looking at is a finding that some products' names just don't seem well aligned with their objectives, with their investment strategies, with their asset composition, or their exposures. And we are concerned that including some words in a product name or stated objective, words like green, ESG, impact, climate, they may create expectations among consumers that are not met. For example, about the types of holdings within these funds. It's not the FCA's role to dictate where firms invest. We do need to make sure that firms describe their strategies clearly to consumers, and firms must not make misleading claims about the ESG credentials of their products. But this area can be complex. There may be good reasons for including investment in a sustainable product that might look wrong at first glance. But crucially, this must be clearly explained to consumers. Let me give an example. It may be reasonable for a transition product to invest in oil and gas stocks if these companies are taking credible action to transition to clean energy. And once invested, firms can influence companies' climate strategies through active investor stewardship. And investor initiatives such as Climate Action 100+, for example, has successfully secured emissions commitments from many companies. The third theme, I think, is around ongoing performance reporting. So reporting of ongoing financial reporting, but is well established, it's consistent. But measurement of performance against the non-financial objectives is still evolving. Some sustainable investment products do not track their performance against sustainability characteristics in a way that will be clear to a consumer. And where products target real-world sustainability impacts, some firms find it difficult to reliably attribute a quantifiable impact to their actions. So the third key challenge, I think, is around ongoing performance reporting. I'd now like to turn to 5 key actions that the FCA is taking in response to these findings. These are not exhaustive, they don't encompass everything that we're doing, but hopefully they provide a flavour of our direction of travel. Firstly, around corporate reporting. We recently consulted to require premium listed issuers to make better disclosures on how climate change affects their business. And these disclosures need to be aligned with the TCFD recommendations. So we're currently considering feedback to this consultation, and subject to what we hear back, we'll be publishing a policy statement in the coming months. The proposal is that these premium listed issuers will have to make TCFD disclosures, but this is on a comply and explain basis. But our full expectation is that most premium listed issuers will be complying. There may be exceptions for particular circumstances, but I think our expectations are clear. We are also looking at the wider corporate reporting on sustainability and whether we can do more internationally to agree common standards. So this includes, we co-chair an IOSCO Sustainability Task Force workstream, and there are some really promising industry initiatives in this area where global standards setters are coming together to try and create a global standard for common international non-financial reporting. And this will be a real significant step forward. Secondly, we want to improve regulated firm disclosures to clients, to consumers, on how they manage sustainability factors. This is both in terms of their dedicated ESG-focused products, but also their wider investment activities. So we are beginning with climate. Next year, we will consult on TCFD-aligned disclosures by asset managers, life insurers, and contract-based pension providers. And we will draw insights from an industry guide we published in June. This was published by the Climate Financial Risks Forum, an industry-led group which the FCA co-chairs with the PRA. And this guide is well worth looking at. It shares best practice on disclosure, risk management, scenario analysis, and innovation. And again, is grounded in TCFD recommendations. Thirdly, as the audience will be aware, the EU is pursuing several ambitious regulatory initiatives under the Sustainable Finance Action Plan. Some of these initiatives will come into force after the Brexit implementation period. So we have welcomed the UK government's commitment in their green finance strategy to matching the ambitions of the objectives of the EU's plans. We are working very closely with government, with other regulators on how to implement the EU's proposals in the UK. Immediate areas of focus are the Sustainable Finance Disclosure Regulation and the EU's taxonomy for sustainable activities. And we fully recognise the benefit of the internationally aligned approaches, and we fully support the government's commitment to promoting globally consistent standards and to strengthen the UK status as a global hub for sustainable finance. This could be a real opportunity for financial services in the UK to become a global leader. Fourthly, we're doing significant amounts of research. So we are developing online consumer behavior experiments. These seek to test consumer understanding and expectation of key ESG terms. And we'll be testing how the presentation and content of product information might influence consumer decisions. We hope to run these experiments later this year, and then we'll look to publish results next year. And these results will help inform whether additional guidance or rules are needed. I think this is absolutely critical. Disclosures only work if they're useful to consumers and if they help consumers make whatever decision the consumer particularly wishes to make. But it's whether real consumers will look at disclosures and make better decisions on their basis that the FCA cares about, rather than tick box compliance with rules. Finally, a critical defense, if you would, against potential greenwashing is to tackle misleading claims as applications for new products are submitted to the FCA for authorizations. So over the last 18 months, we've seen a significant rise in applications for funds with an ESG focus. Now, our rules set out at a high level that financial promotions and communications with customers must be clear, fair, not misleading. And this includes non-financial objectives that a product seeks to achieve, such as reducing the fund's carbon footprint. And we review the strategy, we review the investor documentation and model portfolios of applications to ensure that they meet these standards. And we require changes to the way information is presented to consumers if we aren't convinced. Building on this, we are now considering whether it will be helpful if the FCA articulated publicly a set of guiding principles to help firms with ESG product design and disclosure. And this could help to tackle the concerns I've already outlined and ensure that consumers are protected from greenwashing. So we have 5 areas for potential principles in mind. The first is around consistency in messaging and approach. A product's ESG focus should be clearly stated in its name, reflected consistently in its objectives, in its investment strategy, and its holdings. This is all about ensuring that a product really does do what it says on the tin and it matches consumer expectations. So that first area focused on consistency in messaging and approach. The second area is around a product's ESG focus should be clearly and fairly reflected in its objectives. So where a product claims to target certain sustainability characteristics or a real-world sustainability target, its objectives should set these out in a clear and measurable way. Thirdly, a product's documented investment strategy should set out clearly how these sustainability objectives will be met. This should include describing clearly any constraints on the investable universe, any screening criteria, anticipated portfolio holdings, also the fund stewardship approach and actions the fund manager would take if investee companies are failing to make the desired progress. Fourthly, that the firm should report on an ongoing basis its performance against sustainability objectives. This is about giving consumers the information they need to understand whether the stated objectives have been achieved in a quantifiable and measurable way. And finally, that the firm should assure ESG data quality, understand their source and their derivation, and articulate clearly and accessibly how it is used. And this includes the use of ESG ratings in the investment process. So I'd really welcome your thoughts on these sort of early thoughts for high-level principles, perhaps in the Q&A. We will also be planning to socialise and discuss them further with industry before taking this work forward. So looking ahead and in conclusion, I think sustainable investing is surely here to stay. It's a huge growth area. It's a huge opportunity for the UK. I think the politics, I think the finance, I think the consumer need are all aligned in this space to create a dynamic and growing green finance market. It's a fast-moving space. It's evolving. It's very innovative. We need to ensure that the innovation doesn't come at the expense of undermining trust in the sustainable finance market. As a regulator, we think trust is very hard won, but it's easily lost. Any sort of scandal or mis-selling problem in the space would set the market back considerably. So we all have an interest in building and maintaining trust in this market, and we will absolutely take some of the more sort of traditional hardline regulatory actions if firms are not upholding the standards we expect. And we want you all to tell us where you can have concerns so that we can act. So whilst we'll do that more traditional aspect of regulation, we are also taking all these steps that I've mentioned, which try to enable the growth of this market. I think regulation can have that positive impact as well as the traditional approach to ensuring that rules are followed and wrongdoers are held to account. And I think that by working together in the interest of consumers, we can ensure this market grows and that the financial services sector plays its part in fighting climate change. Julia, thank you.
Right, click a few buttons there. Richard, thank you very much. That was fantastic. That was exactly the kind of stuff I want to hear. We have got some great questions for you, but I'm really grateful for you outlining all of that. I think possibly the one thing that I didn't hear was reference to MiFID II specifically, but I think with what you said and what I've discussed with your team more recently is that in many ways that's kind of neither here nor there, because it's a mechanism, means to an end. Therefore, if we're aligning to what the EU is doing anyway, it doesn't particularly matter. Is that your view?
Yeah, I think that's right. I think for us with MiFID II and the rest of the European initiatives as we leave the European Union, I think there's a number of questions for UK regulation. We'll be working pretty closely with Treasury on as well to ensure the UK approach. I think there is a difficult question. I think we would need to think very hard before changing and sort of departing from European standards. And there is, it's a question because, international business, effectively, cross-border trade, et cetera, alignment on something like green finance is critically important. Mm-hmm. Equally, there may be some idiosyncrasies about the UK market where we could align in terms of outcome and in terms of principle, even if some detailed rules are slightly different. So that effectively is something we'll be considering as we exit the European Union. Yeah, I think most of us would entirely support that. I don't want to speak for the 200 and whatever it is people that are on, but certainly to me, alignment, absolutely. A lot of us. The UCSIF members in particular, we've been having conversations with the EU on this for decades. I mean, there was a commissioner called Dominic Bay who came over in about 95 to talk about this with us. And this stuff has just rumbled on, and we've all been feeding in. And then just the thought that this may all just kind of evaporate as it gets so close to being, frankly, fantastic. It's just too awful for words. No. I think that, the government the UK government have committed to effectively sort of delivering the outcomes of the sustainable the EU sustainable strategy. I think we are completely aligned with that. Exactly how we do it, I think, is still TBC. But we fully recognise the importance of alignment, and certainly industry are basically telling us, the challenge of different standards in the space is real. Yeah, for sure. Okay, so I'm going to fire some questions at you, and I'm literally just going to read them off the screen. So it may be that my reading is a bit jolted, shall we say. So one here from Richard Essex. What needs to be achieved to fully align environmental risk to financial risk for retail investors? So practical implication of this is whether an IFA's risk questionnaires can be built into the final impact of poor ESG reporting. So I think, well, I'm sure you get the gist of that. So,
what exactly do these need to do? I guess that's partly process as well.
Yeah, so I think I may sound like a broken record on some questions in terms of talking about data and the disclosures, but so I think it all starts, I think, with really good corporate disclosures, with really clear corporate disclosures on the sort of the environmental risks of whatever, of that particular corporate, of Vodafone, of Rio Tinto, whoever that is, in a really clear and tangible way. And I think TCFD is the right place to start with that. That's why we're consulting on the proposal to make that a requirement for premium listed issuers. And effectively, once you have that and you have that effective, then I think you can align and the sort of the financial risk in terms of the sort of those environmental considerations, because effectively they become one and the same thing. The potential difficulty might be about timings. So there's a question of sort of immediate returns on a sort of annual basis over the next year or two versus a slightly longer term tail risk in terms of if these companies are slow in changing. But I think if you look at the sort of the significant asset price write-downs of a couple of the oil companies over the summer, I think you're seeing that sort of time horizons become closer together. And I think as significant investment in green energy develops, effectively what will happen is green energy will become significantly cheaper and fossil fuel energy will become significantly more expensive over a number of years. And by doing that, I think effectively environmental risk just becomes a facet of financial risk in terms of returns. I think we will also need an additional, as it were, questionnaire in terms of the IFA risk questionnaire in terms of, okay, does the customer also want to think effectively about the ethical considerations of investment as well? So I think they're two slightly different things.
For sure. I mean, some of the stuff is clearly material, and some of us have been, maybe I called it too early. Maybe, a lot of the people who are speaking today, maybe, we were worrying about it before it actually hit the markets, but it was always going to hit. So yeah. I guess, with Richard's question, it's more around, IFAs, what do they have to do? And I think, that's something that hopefully we'll pick up on over time as that core data feeds its way through. But I think he's absolutely right. IFAs have got to bring it into their discussions and look at the two different aspects as you've outlined. Thank you. So I'm going to read a couple here. So Annalise Toberman has got a question here saying, interesting to hear that the FCA will be considering EU sustainable finance disclosure and taxonomy first. Is the UK also considering adopting the EU suitability rules? I think that touches on the same thing you just touched on there. So suitability stuff in MiFID. So I think maybe that's a short answer. So for example, will IFAs be expected to bring this into their suitability assessments? I think very quickly that's kind of an over time yes, but you answer it.
Yeah, I think that's right. I think over time, yes. Again, I mean, I think with everything we're doing, we are trying to balance how quickly the data and information and disclosures are good and effective versus introducing requirements. So for example, introducing very hard requirements on suitability, I think today, whilst those disclosures are still work in progress effectively, I think in effect, you will be increasing the cost on industry. And I think that, that money is passed through to consumers through higher prices. And I think until we can be sure the data is effectively, working well and is available, I think there is a timing issue. I think in time, it will entirely be integrated in terms of suitability, IFAs asking those questions and sort of making those recommendations. And of course, there's nothing to stop the IFAs doing that now.
Well, I mean, I guess the general issue there has been that IFAs, because they haven't been told that they ought to, and they're being checked up on hundreds of other things, they've tended to not because you've told them not to. So could we maybe expect something from the FCA at some time where you're articulating that clear, fair and not misleading? That means you've got to bring this stuff into it at some way, even if you're not necessarily expecting them to, because you can't expect an IFA to look at, individual pricing for an oil company. That's not going to happen. But I think to get around that, to get that signal out there that yes, this stuff is coming, guys, please don't stick your heads back in the sand. I know we've got you all rattled because you're expecting something next March. I don't know. I would hope that some people would agree with me on that. Just to, this is all part of the investment universe, guys.
Yeah. Look, and we are considering this as part of the package. So if effectively, you've got the EU sustainable finance initiatives going on, and then effectively we are just working closely with government in terms of how we make that work in the UK. The government is committed, absolutely committed to achieving the same outcomes as is set out at an EU level. So it's part of that package we're talking to government about and we are considering. I'm afraid I can't give a clear indication now in terms of timing of when something like that.
I've got to ask.
But in at least the medium term, if not the short to medium term, I think it's clear this is the way that investment is going, and I think all the stats and evidence suggest that this is the way the way that investment is going in the UK.
Yeah, I hope we can get that message out in a balanced way to advisors, so that they don't automatically think they've got to have conversations with everyone about animal testing or whatever, because obviously some people really, really care about that, and others don't. So it's an optional kind of thing, I guess.
Yeah. The other thing I'd add on that, and this is, I think within ESG, I think with the at the FCA and Bank of England at the moment, there is a focus on the environmental. I think there is a focus on the environmental, and I think that is moving quicker than perhaps some of the other aspects of ESG. To be very frankly, there's united political will on the environmental side at an almost global level. So that makes it easier for regulators and central banks to say, we're pursuing this case. It's slightly harder on social questions, but I think on the environmental side, you'll see us move pretty quickly on that. Yeah,
well, it's all interconnected anyway. If we don't save the planet, then you can forget social issues to a large extent, because they'll have a whole range of other problems. So I think it's right to bring environmental in first, but whilst remembering that the social stuff sits within it or alongside it. We've actually got loads and loads of questions. So for all those people who posted, I'm sorry, I can't get through to all, I can't do all of them. But I've got one here from Christopher Cade, and I'm coming back to the IFA side because this is who I've invited as the core audience for this. But he's wondering if you could give some kind of example of what you think best practice would then look like for an advisor in this area now. And we've had other people commenting on the documentation all being too heavy going, the requirements for retail investors, KID documents, etc. This is my words, not theirs, but wading through toffee. We just know consumers don't. They're not going to read it. So can you give an idea of what you think this should look like in maybe a year or two out?
Yeah. So I think, and again, I think we've done testing already, behavioral economics testing about disclosure. We are consciously aware of how consumers actually read documents, or potentially, particularly with online sales, etc. And that is what some of the testing I think I mentioned that we'll be doing later this year will really, really inform, which is actually almost not what do we need to document, but actually what is useful to consumers. And I think that will be the focus of sort of when we look forward and think, okay, has the right information been disclosed? Has the right conversation been had? We'll want to be looking to the effectiveness of that rather than the sort of the absolute detailed content of it. I agree. These lengthy documents, some of them prescribed in EU regulation, some of them prescribed in our own regulation, are frankly a fairly old school sort of traditional analog way of regulating. So both in terms of the ESG space, in terms of doing this testing later this year, but also as we think about how we regulate the advice sector in future, I think that question of how do you communicate and ensure customers have the right information that's actually useful to them, as opposed to complying with a detailed regulatory requirement. And I think we've publicly said, we have some views on some of these documents and whether they are that useful or not, is absolutely something I think will be taken forward. Yeah.
So I've just been given a note saying we're overrunning, but can I ask you one probably quite unfair question put by Matt Wood? This may not be something that you can give any detail on at all, but hopefully a short one. Is the FCA's pension plan invested sustainably?
I'm afraid I genuinely can't answer that because I don't know. I know there's a variety. You know, we have choices within our pension plan to do that. I can't give a straight answer. Just I simply don't know. I'm afraid. What I can do, Julia, particularly as I know the team's on the call, we can sort of take away all these sort of other questions that we've not had time to answer. And I'm not sure if you're doing a sort of round robin sort of communication.
I will follow up, yeah.
But we can provide some answers to the rest of those questions there.
That would be so kind. Thank you. Yeah, I'd really appreciate that because I can't get through them that fast without getting in a complete mess. So thank you very much. We're running over slightly, so I'm just going to close and say I appreciate you doing this. I appreciate that your team has always been open to discussions. You know, we hear a lot of mixed reports about the FCA. My reports on the FCA are good. They listen, they talk, they get together. So I really appreciate the approach that you will take.